Here is some humor, guys. Kick off 2025 before we go make some money. Enjoy.
Warren Buffett was once told in the '08 crash, Mr. Buffett, you have lost $10 million today. Do you know what he said? He said, I haven't lost anything. I haven't sold. Me and Buffett have the same mindset. I'm tens of thousands in loss on my Euro USD trades, but I haven't lost anything because I haven't closed the trade. No stop loss. We share that mindset and inshallah, the markets will turn around and I will be profitable. That's the problem with these traders nowadays. Stop losses, closing their trades. Don't close, don't lose.
Exactly, yeah.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were bullish early on in the morning and erased the session gains on Thursday to kick off the first trading day of the new year as Wall Street returned from its holiday, and we actually did see quite an uptick in volume today, and we will continue to see that throughout the next couple of trading sessions as volume comes back in the market. And it was truly a mixed day today. There were many stocks and sectors that were green, many that were red. Such goes the market in the new year, kicking things off on a mixed front. But we did see great outperformance here from energy as well as utilities. And then healthcare was kind of mixed as well, but Eli Lilly, AbbVie, some of these big names holding it together. Communication services was the epitome of today's trade. You could see that we had very mixed price action here in Google, telecom, as well as entertainment, but Meta holding up the entire situation together, up 1.89% today. In the discretionary space, Tesla was down 6%, Amazon was up 0.47%, the yin to the yang. However, Tesla's 6% decline meant that the discretionary sector was the worst performing sector today. Apple fell 2.87%, Microsoft and all of infrastructure was down. However, semiconductors was very, very bullish. Nvidia up 2.73%, followed by AVGO. And we saw equipment manufacturers and computer hardware also very bullish on the back of what we saw with semiconductors. However, software as a whole, pretty bearish except for Uber, which was up 0.472%. And then like the market, we saw very, very mixed price action here in financials. A very mixed day across the board. Only 4 sectors gained. The remaining sectors lost, with the S&P 500 falling 0.26%. Now, the market is about 10 minutes away from closing, so this might be not completely up-to-date data, guys. However, as of right now, the SPY down 0.26%, with the worst performing sector being the XLY on the back of Tesla's news. And we're going to talk about why Tesla was a complete dumpster fire today. The best performing sectors being XLE, XLU, XLC, XLV, right? So that's healthcare, communication services, utilities, and energy. And in the last daily recap show, we spoke about this value rotation we're starting to see in the market. And that kind of continued today. Energy is a value sector. Some would say so too is XLC, particularly when you look at Meta and Google relative to the other Mag 7 names. And then the entertainment and telecom services part of that market. And then XLV. What we also saw today was a little bit of a defensive rotation. If we actually just go back to this chart right here and we zoom into the communication sector right here, telecom services, right? This is actually a defensive component of the market, very similar to what XLP is staples and healthcare is to the market. So telecom services is a defensive component, but it's actually notched in a subsector of communication services. So to see comm services up 0.232% really goes to show a bit of a defensive rotation, especially when we saw utilities, energy, and healthcare, those defensive sectors also up there in the fold. Maybe not so much energy. Energy isn't a defensive sector. Nonetheless, we did see a bit of defensive buying today. We also did see a bit of value, and those two did collide. And the broader market was really left in the dust. But then when we break it down into its factor and size segment, the large segment actually was the worst performing sector here today. However, large growth on the back of Nvidia was pretty much flat. They make this box red. They should really make it gray. I don't know why they do that. But large value, large core was down 0.4, 0.3% respectively. Mid-cap growth was actually positive here today, along with small cap growth. Very, very constructive price action. And then small cap core was flat today. And then we actually saw small cap value fall along with mid-cap value and mid-cap core, with mid-cap value actually being the worst sector here today. So very mixed price action across the board. There wasn't really much of a trend of anything. There was just a lot of market impact news that really saw stocks falling today. I think what really did hit some of these like smaller cap names was Carvana. Now their stock was down 2.95%, and this was on the back of a Hindenburg short report. Hindenburg Research accused Carvana of questionable accounting and undisclosed loan transactions of 800 million. The report flagged insider stock sales, high valuation, industry challenges, and warning of significant risks for customers and investors. And I was looking at this, and it really has to do with their loan origination book. The CEO of Carvana and the CEO of their loan origination platform, which is Carvana's CEO's dad. There's a lot of questionable things going on there. I think I was briefly skimming through it. I saw something like 40% of the loans that Carvana originate are 30 days delinquent, something crazy like that. And we'll see how the stock reacts in the days and months ahead. But onto the bigger boys that really moved the market today. Tesla was down 6.26%, and that's because its year-over-year deliveries fell for the first time since the company actually went public, guys. Deliveries missed. That's why it was down 6% today. And yeah, very ugly price action. You can see this is when deliveries were announced and pretty much lower lows to finish the day. And this really did drag on the overall market. Now, Apple also moved the market today. It was down 2.82%. And that's because we got some very devastating news from China. Apple have started discounting their products in China amidst a very weak economy and a weak consumer. And you know it's bad when Apple start discounting because it's very rare for them to do that. What also didn't help sentiment today was just some of the stuff we saw on the political realm. You know, there's a lot of conversation with Donald Trump, the Democrats, the Republicans, and the debt ceiling. And, you know, even though it's not really anything to worry about, in my opinion, there will be a resolution. It still weighs on sentiment and the overall market. And then what we also saw today was yield and the dollar rip. And that's what really helped erase the gains. It was just a very strong dollar and strong yields. And that was partly due to the economic data. Initial jobless claims came in a lot stronger than expected, 211 versus 222. And we got some very big revisions to previous data points. We also got the global manufacturing PMIs. This came in better than expected, 49.4 versus a consensus of 48.3. And then you can see here the 30-year mortgage rate now at 6.97%. Previously was 6.75%. And again, all of this sort of saw the dollar rip, which is again not good for multinationals, not good for large cap stocks, and then yields rise, which is not good for mid caps and small cap stocks. And all of this together, along with the Tesla news, the Apple news, the political news, saw stocks erase their early morning gains because the S&P 500 and the Nasdaq 100 early on were very, very bullish. And then we saw a slow downtick as we got all of this news and all of this data. And the sad thing is here, guys, today we actually lost the 150-day moving average. The 200-day is the last remaining soldier on the field. Things not looking good. Market momentum continues to deteriorate across the board. However, market breadth today was actually kind of solid. We had more advances than we actually saw decliners. However, the decliners were in the big names, stuff like Apple, stuff like Tesla, and that's really going to weigh on the market. Nonetheless, under the hood, market breadth was a lot more solid than many people thought. But let's hop on the charts. And looking at the charts, guys, and if you ask me, I say bring back 2024. We had a pretty vicious and a pretty ugly start to the year. Now, the S&P 500 and the Nasdaq 100 fell about 0.2%, pretty much slightly less so for the Nasdaq 100. The IWM, the outperformer, up 0.08%, so pretty much flat for the day. But we are seeing some slightly positive developments here in the after hours, but the RSP, mid caps, and profitable small caps are all down about 0.2, 0.3%. A very broad-based sell-off across the market. However, very interesting to see the IWM did gain on the back of a stronger dollar as well as yields. Now, it does show here that yields did fall 0.31 and 0.13%. But if you actually look at the 10-year yield and what it actually did today, if we go to the one-day chart, right, like yields from 9 a.m. on the market open actually did rise. So we did see a gain in yields net. And yields right now, the 10-year yield sitting at 4.55%. Absolutely insane. And yeah, so, you know, higher yields today did actually impact the smaller cap, mid cap names. A stronger dollar did impact the larger cap names. And that was on the back of all of the news as well we saw today. And that's why we did see a decline in the equity markets. Bonds did gain as well as gold. gold and silver. So we did see safe havens catch a bid today, as well as some of the defensive names, which we spoke about earlier on in the video. So we did see a rotation into defensives, precious metals, which is defensives, right? As well as move to the dollar, as well as a move to bonds. So very interesting trade. The market not really liking some of the movement we've seen, and we actually did get a little bit of a defensive rotation here today under the hood, which is a little bit scary. And if we do continue to see that in this first week of January, you know what they say, as January goes, so does the rest of the year. So if this defensive rotation, the safe haven rotation continues into the start of the year, into January, we really need to be prepared for what could come for the rest of 2025. Nonetheless, looking at the S&P 500, when we look at equities, nothing really has changed, guys. We are still sort of consolidating here at this put support zone in negative gamma. Yes, we did actually make a lower low, relatively speaking, to this wick. However, the bulls did come in a very big way, and we are now above the put support. Very interesting. So we're holding this line. We haven't broken the Trump gap up after the election. Things looking largely constructive for the S&P 500. There was just no conviction in the bears to actually close below the low we actually saw last week. So there's that. But we did see conviction of the bears to sell the highs here as well. So that is largely not constructive for equities. The Nasdaq 100 doesn't look that good, but that's because it's actually outperformed to the downside relative to the broader market. If we actually look at the RSP, it's been a bit of a dumpster fire. It is sort of consolidating right here, like it is with the S&P 500 and the Nasdaq 100. And that's really all equities need to do right now. I think heading into tomorrow and then heading into next week, I think what we really need to continue to see is just a consolidation here and staying above the put support. If we can see that for the S&P 500, the Nasdaq 100, as well as the RTY, that's gonna be constructive. And then we can actually maybe move higher based on some of the seasonal trends we do see in the first week of January after last week of the previous year. However, I think in the year and now over the next 2 days, what the bulls need to do is hold this level. We can consolidate here. That would be constructive. But if we start breaking down from these consolidation areas, right, and then we probably will go lower. I don't put it out the ballpark that we could see lows like 56 in the mids, 5600, like right here. We get to these lows right here. That would be about a 10% correction from peak to trough. Now, guys, I am still bullish. I do want you guys to buy all dips, and this is a great place to add. If we continue going lower, this is probably the next zone to add, circa the 5650 area, and then we'll go from there. However, if markets want to continue immediately, they need to hold this level right here and start showing some bullish price momentum to the upside. Volume was still a little bit lackluster today. However, we are starting to see more volume come through into the market, and we'll see what that looks like for the rest of the week. If we start to see more volume come into the market, and then we do see some of the mega caps rallying, the S&P 500, the Nasdaq 100, maybe even the RSP, that would be constructive, and then we'll probably go higher. But if we start breaking down below these levels, guys, our aim is like the 5650, 5600 area there, and that would just be like a 9 to 10% pullback from where we are right now. Now, let's actually have a look at gold, because gold was up 1.32%. It's actually forming like a very solid like flag pattern right here. And if it goes ahead and continues to like break to the upside like it is right now and break some of these highs and continue to move up, that would be a trend continuation. Now, this low right here is actually a higher low relative to this low, and we are starting to see very constructive price action. That's a very bullish candle in gold. Gold looks like it wants to go higher. We've had like a period here of pretty much stagnation for about 4 to 5 months. That's really, really good, because gold has just traded sideways for the last 4 to 5 months, meaning it can then make its next move higher. In other words, institutions were taking some profits, repositioning themselves, and the next move higher in gold is coming. I do see 3,000 gold by the end of 2025. Very similar situation for silver, although a little bit more volatile. We've traded pretty much sideways for the last, I would say, 9 or so months. It's now time for silver to make its next move higher, because we are making higher highs, higher lows, and we did actually make a higher high right here. So silver and gold poised to go higher. If you're looking to diversify your portfolio, definitely look at precious metals. That's what I would look at. And guys, individual names. Guys, I actually bought EVVTY. I bought some today. I bought some previously. Now, Evolution outperformed the market today. It was up about 1% in total. At its peak, it was up about 2%. I bought some today. I'm going to continue buying until I have a pretty sizable position. I think I might make it anywhere from 5 to 7% of my portfolio. But this is sort of like a growth stock trading at a value stock valuation. I like the name. Guys, other names that I also do like, PayPal, which was up 0.97% today. Again, outperforming the market. I think PayPal is going to go to 110 by the end of 2025, maybe even 120. I think we're just seeing a little bit of consolidation here after the 50% rally in just 4 months off the lows that we saw here in August, right? So we're consolidating. That's really good. You want to see that. You want to see some profit taking and then repositioning, aiming for the next move higher. So if you guys are looking for value right now in this overvalued market, look at PayPal, look at Evolution AB. There are definitely risks with Evolution, so do understand those risks, but I do see value in these names, guys. And also look at the IWM. You know why the IWM is rallying right now? It has to do with earnings. The next quarter earnings growth for the IWM is expected to come in at 54%, right? We've seen negligible earnings revisions to that 54% mark, meaning that if we hit those earnings figures, right, the IWM is looking cheap in hindsight, and it's probably going to rocket up from here. So guys, there's a lot of factors working against stocks right now, but there's a lot of fundamental drivers working for stocks, along with the positive macro developments we saw today. In other words, I think this is a buyable dip opportunity. However, if we start breaking below these key levels of the support, of the put support, especially in the S&P 500 and the Nasdaq 100, we can definitely go lower. But I think any dip we do get here at the start of the year, you want to buy that dip because we are going to really rally into the second and third quarter of 2025. But we are starting to look for an opportunity. And that means if we do break this level right here, we can go lower, aiming for, in the Nasdaq 100, we could see maybe even the 19,000 handle. In the S&P 500, the 5650, maybe even the 5500 handle. So that's what we're looking for right now. And you could see some outperformance here in the golds. You could see outperformance here in metals, maybe Bitcoin, as well as some of these smaller names, as well as stuff like the IWM, especially if those earnings materialize the way we think they are. So guys, expect volatility. This is what 2025 is going to be like. It's going to be very whipsawy, but we are going to buy dips all the way up before we get a massive blow off top. That's sort of what I'm predicting here in 2025, maybe into a little bit of 2026. So continue to stay long. The macro and fundamental pictures continue to drive stocks. However, there will be volatile dips. Don't get scared out of your positions. Just have capital ready to deploy and buy those dips. And guys, we're going to talk about sentiment. This is the community YouTube poll we do every single week. And if you guys want to be part of this, go ahead, subscribe, hit that like button, and then you'll see this poll in your feed. And I asked, how are you feeling about the S&P 500 going into this shortened New Year's week? And 46% of you guys were bullish, 37% were bearish. Now, this is a stark difference to the sentiment polls we were seeing at the end of last year, where we were seeing something like 15% bearish sentiment, 15% neutral sentiment, and the majority here in bullish sentiment. A huge change has shifted, and that's because stocks as a whole haven't been acting well in the last couple of weeks. Coming off a bullish year, I get it. However, sentiment is still very bullish, all things considered, and you have to look at the underpinnings and the fundamentals, and even the strategists see it too. They are very bullish, not necessarily for this week. This is 2025 year-end forecasts, and guys, we have very bullish consensus estimates. You look at the bottom of the range here, Barclays, from where we are right now, this is an 11% return if we are to finish at 6,600 at the end of the year. For those of you that want to know, my target for 2025 is 6,669, pretty much where Barclays see the S&P 500 ending. Now, the most bullish target on the street, Oppenheimer at 7,100, extremely bullish price target, and this represents about 15% upside from where we are right now. So they see double-digit mid-teens growth throughout 2025. But what's really striking about this is that consensus forecasts are actually in a very tight band. All things considered, this is a very tight estimate, and most of the strategists see growth into 2025. And last time we had such a tight band of consensus estimates and market momentum was bullish, we actually exceeded that. In 2016, the S&P 500 closed the year out at 2260. Strategists saw upside targets of 2300 to 2500, a very tight consensus band. What did the S&P 500 do? We finished at 2680, so we absolutely smashed consensus estimates. We did a very similar thing in 2008. We had a tight band of consensus estimates and we absolutely smashed it to the downside. So if history is anything to go by, whenever we get a tight band of consensus estimates, we either smash it to the upside or downside. And based on the market fundamentals, I favor upside, but anything can happen. Looking at the overall week and what to expect in the next couple of days, however, based on this analog right here, after we've had a negative end to the previous year, like we did in 2024, we saw negative 1.15%. What are the returns we can expect in the first year of the week? And normally when we have a negative week, the next 5 trading days tend to be very, very bullish. Average returns 1.32%, 15 wins, 5 losses. So seasonality for the next week, definitely on the side of the bulls. However, when you look at the longer term picture for the next year, heading into the first year of a US presidential cycle, what we're really doing now for the first couple of quarters is really looking for a bottom for us to get long in this market in the S&P 500. You can see here that generally speaking, in the first cycle of a presidential year, we see a little bit of upward momentum leading up into the inauguration. Then we actually see downward momentum all the way into March, circa April, where we sort of put in this double bottom right here. And then we actually bounce off the lows and have a blistering rally all the way into July, into August, where we've put in a top, and then we actually see lower lows, lower highs, and actually finish the year negative for the year, seeing average returns of about negative 3% in the first year of a presidential cycle. However, we want to ride this trend right here, so we will be looking for a bottom in the first couple of quarters of this year. And guys, all dips are buying opportunities as long as the fundamental picture stays sound. If we get earnings of 9.6% year in the fourth quarter, 12% in the first quarter, second quarter, and 13% in the third quarter of 2025, all dips should be bought because we will go higher, especially with margins expected to expand and the macro environment looking favorable for growth. Now, if we actually look at GDP and the macro, things looking rather robust. Right now, real GDP tracking for the third quarter at 3.1%, consumption 2.5% of that, fixed investment 0.6%, government spending 0.9%. This is where it gets crazy. Residential fixed investment, right, which is essentially the real estate market, actually was a drag on the overall GDP figure, and this is one of the biggest components of GDP. Net exports was a drag, and change in private inventories was also a drag of 0.4% and 0.2% respectively. If we can see growth in residential fixed investment with lower rates and affordability increasing, this figure right here is going to continue to drive growth in GDP above trend, which is above 2.5%. And at the end of the day, guys, the consumer looks really well positioned for growth into 2025. If we look at household debt service ratio, looking very, very robust at a historical average going back to as far as the 80s. And we can see, yes, delinquencies are ticking up in auto loans and credit cards, but remaining below the average year when it comes to mortgages as well as student loans. And when we break it down further, despite the large sustained increase in interest rates over the last couple of years, consumer finances show only a moderate sign of stress. Credit card delinquency rates have actually not risen for prime borrowers, this blue line right here, but they have increased by 5.6% for subprime borrowers. And this is when the market has actually tightened and the total sample has actually seen negligible growth, telling us that the consumer is still looking very, very good. When we look at other metrics for the consumer and the economy, we look at federal employment tax receipts for the full year 2024 sitting at 5.5% growth, very, very robust. And that means employee income, employee compensation has remained very solid. And as a result, tax revenue has come in a very big way, seeing 5.5% growth from the year prior. Very robust. You love to see that. And this is further going to support the macro environment and the economy into this year 2025. Looking at data for the rest of the week, guys, tomorrow we have the big numbers, ISM manufacturing and ISM employment. Today we had this data points right here. And then earnings, guys, we really have nothing for the rest of the week. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.